Hello, everyone. Today is October 1st, 2024. This is Brent Foster, and this is the Northbound Wealth Podcast, weekly market insights. We try to do this every week, sometimes a little longer, but we give you updates on the market and insights in personal finance, all kinds of things that we discuss and talk about. Welcome to the show. Let's dive in. Rate cut momentum. DC averts a shutdown. That was the headline for basically reviewing last week. Stocks moved higher last week, continuing to build on the momentum generated after the Federal Reserve decided to cut short-term rates by 50 basis points, or 0.50%. The Standard & Poor's S&P 500 index gained 0.59%, while the NASDAQ composite rose 0.95%. The Dow Jones Industrial Average added 0.62%. The MSCI EFA index, which tracks developed overseas stock markets, gained an eye-catching 3.53%. So international markets were buoyed and boosted by what happened in China. So we might talk about that a little bit later. So Congress passes a spending bill. So basically, let's review last week. Stocks started the last week tepidly, but in the green, as investors mostly shrugged off Tuesday's weak consumer confidence report. Then at midweek, markets put on the brakes as investors appeared to take profits after a 4-day winning streak. So then on Thursday, markets rallied on the news that the final Q2 gross domestic product estimate showed the economy increased by an annual rate of 3%. Then on Friday, the PCE, or Personal Consumption and Expenditures Index, showed inflation had cooled slightly more than expected in August, which some believe may influence the Fed's decision on short-term rates at its November meeting. Finally, a continuing resolution was passed by both houses of Congress last week and signed by President Biden Friday morning, assuaging concerns over a government shutdown. The resolution funds the government until December 20th. So that'll be exciting to talk about at the end of the year. Y-Charts weekly market insights. The Dow is up 13.51% this year. MSCI EFA index, that's at international space, is up 13.79%. NASDAQ composite is up 21.84%, and S&P 500 is up 21.70%. That's all year-to-date numbers. And the S&P 500 is actually currently trading between the 5,700 and 5,800 range, all-time highs again. 10-year Treasury yields or rates are 3.75%. So trading below the 4% range. And 1 month ago, it was at 3.83. 3 months ago, it was at 4.29. And 1 year ago, 4.61 on short-term treasuries and short-term notes. So basically, the 3 month to the 2 year, a lot of those yields have come down. And you'll notice that reflected in some of your savings accounts, or maybe if you have one of these notes or T-bills maturing and you go to renew it, it's not going to pay you the same amount as it did before. And that's because interest rates are coming down. So it begs the question, what are you going to do? As inflation comes down, the Fed starts to lower rates, and then your short-term Treasury notes roll off. If you have questions around that, you can give us a call at Northbound Wealth Management. We can kind of share with you our thoughts. Thank you, Y-Charts, for that data and that information. So China's stimulus package. So this week, the head-turning performance came from outside the U.S. This is a review of last week as a reminder, and it's kind of continuing on this week. As measured by the MSCI EFA, which is Europe, Australia, and Far East Index. International stocks rose more than 3% following news of China's stimulus package, which could be as much as 2 trillion yuan, or in USD, $284 billion. That's a massive amount of stimulus. And the coordination of that, by the way, across the government and the corporations in China, the coordination of all of it is what's profound too. It seems like everybody's in on this big move to stimulate China's economy after a 3-year bear market. So China's program also cut bank rates, reserve requirements, and lowered a key short-term interest rate, While the EFA index doesn't track stocks from mainland China, the stimulus package had far reaching implications for other countries. This week, key economic data Monday, Fed Chair Jerome Powell speaks, Fed official Michelle Bowman speaks. Tuesday, ISM Manufacturing Index, construction spending, Fed official Raphael Bostic speaks. Wednesday, ADP employment report, motor vehicle sales, Fed officials Beth Hammock, Alberto Musaleum, and Michelle Bowman and Thomas Barkin speak. Jobless claims on Thursday, factory orders, ISM Services Index, 10-year Treasury note announcement, Fed officials Raphael Bostic and Neil Kashkari speak. So a lot of Fed heads are going to be talking this week. We're going to be paying attention to that. Today is October 1st as a reminder. So it's actually Tuesday. So some of this stuff for Jerome Powell is already getting kicked off. But there was news today of an imminent strike from Iran into Israel. So that's kind of the whisper news today that everybody, including the U.S., is getting ready for that, which could take place tonight and overnight in the next coming days. So we'll see how that all plays out. The stock market is trading down a bit today, and it happens to be Tuesday morning. So we had a nice move into the end of this month, and then we're getting a sell-off here to start October. A lot of positioning ahead of the jobs data that's coming out on Friday. That's probably the biggest thing everybody's going to look at because of all the adjustments in a lot of the economic data that we're getting. So this week, notable companies reporting earnings, Nike and Paychex, that would be today, Tuesday. Thursday, Constellation Brands, so we'll follow that. Now, our tax tip of the week is selling your car or buying from a private seller is the question. Here are the tax tips that you should know. If you're selling your car for less than what you paid, you likely won't need to pay any sales tax because the IRS considers selling a used car for less than what you paid is a capital loss. However, if you're selling your car for more than what you paid, like if it's a classic car you've restored and it's increased in value, you may need to pay sales tax. If you're buying a car from a private seller, you may need to pay sales tax, but this sales tax doesn't go to the seller. It goes to the Department of Motor Vehicles and is part of your car's registration. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was actually adapted from Car Gurus. All right, so we've got a lot of good stuff coming your way. Stay tuned for the next segment. Thanks. Mortgage refinancing surges, what you need to know. Recent data shows a significant uptick in mortgage refinancing applications. Here's what's happening. Refinancing applications jumped 20% in 1 week. The average 30-year fixed-rate mortgage dropped to 6.13%. And refinancing now accounts for over half of all mortgage applications. This trend could present opportunities for homeowners looking to potentially lower their monthly payments or adjust their loan terms. As always, it is crucial to consider your financial situation and long-term goals when deciding about refinancing. And this article was published on September 25th, 2024, CNBC's website by Diana Olick. Great job going through that. The longer version, you can Google search that and check it out. I'll have links in the show notes. But I thought that you guys should be aware of the mortgage refinance boom, and it's taking hold. Hello, everyone. I just posted this to social media, but it was an article from CNBC. It says 25% of consumers recently used Buy Now, Pay Later, which is abbreviated as BNPL loans, according to CNBC, which they published this at the end of May 28th. As these instant gratification payment plans are on the rise in popularity, it is crucial to understand their impact. They're the second most used form of credit after credit cards. 8% of adults use BNPL for necessities. 12% of Gen Z, ages 18 to 27, used BNPL for essentials in the past year. These loans can be a slippery slope to phantom debt, which is not reflected in credit reports. So, as financial professionals, we're here to help you and your family develop flexible budgets that can be designed to withstand fleeting temptations. They can also be structured to help manage unnecessary debt. If you have questions about this type of stuff, feel free to reach out to us, but try to stay away from it. Stay away. All right. Make year-end tax planning moves before it's too late. This was an article sent by Peachin, Schwartz, and Weingart here, locally here in Indianapolis, Indiana. Fishers, actually, to be more precise. They are a CPA firm, and I like the guys over there, and this is not a paid endorsement or anything like that, but this is an article that they sent out through their blog, which I appreciated as a client. So thought I'd share it with everybody. I feel like it is relevant and think you guys will get a lot out of it. So with the arrival of fall, it's an ideal time to begin implementing strategies that could reduce your tax burden for both this year and next. One of the first planning steps is to ascertain whether you'll take the standard deduction or itemized deduction for 2024. You may not itemize because of the high 2024 standard deduction amounts, which is $29,200 for joint filers, $14,600 for singles and married couples filing jointly, and $21,900 for heads of household. Also, many itemized deductions have been reduced or suspended under current law. If you do itemize, you can deduct medical expenses that exceed 7.5% of adjusted gross income or AGI, state and local taxes up to $10,000, charitable contributions, and mortgage interest on a restricted amount of debt. But these deductions won't save taxes unless they're more than your standard deduction. The benefits of bunching. So you may be able to work around these deduction restrictions by applying a bunching strategy to pull or push discretionary medical expenses and charitable contributions into the year where they'll do some tax good. For example, if you can itemize deductions for this year, but not next, you may want to make 2 years worth of charitable contributions this year. Here are some other ideas to consider. Postpone income until 2025 and accelerate deductions into 2024 if doing so enables you to claim larger tax breaks for 2024 that are phased out over various levels of AGI or adjusted gross income. These include deductible IRA contributions, the child tax credit, education tax credits, and student loan interest deductions. Postponing income also may be desirable for taxpayers who anticipate being in a lower tax bracket next year due to changed financial circumstances. However, in some cases, it may pay to accelerate income into 2024. For example, if you expect to be in a higher tax bracket next year, contribute as much as you can to your retirement account, such as 401k plans or IRAs, which can reduce your taxable income. High-income individuals must be careful of the 3.8 net investment income tax, or the NIIT, on certain unearned income. The surtax is 3.8% of the lesser of 1. Net investment income, or the NII, or number 2, the excess of modified AGI, or modified adjusted gross income, over a threshold amount. That amount is $250,000 for joint filers or surviving spouses, $125,000 for married individuals filing separately, and $200,000 for others. As year-end nears, the approach taken to minimize or eliminate the 3.8% surtax depends on your estimated MAGI and NII for the year. Keep in mind that NII doesn't include distributions from IRAs or most retirement plans. You could sell investments that are underperforming to offset gains from other assets. That's what we do here quite a bit, which is called tax loss harvesting. If you have questions about that, reach out to Northbound Wealth Management. If you're age 73 or older, take required minimum distributions from retirement accounts to avoid penalties. Spend any remaining money in tax-advantaged flexible spending account before December 31st because the account may have a use it or lose it feature. It could be advantageous to arrange with your employer to defer until early 2025 a bonus that may be coming your way. If you're age 70 and a half or older by the end of 2024, consider making 2024 charitable donations via qualified charitable distributions from a traditional IRA, especially if you don't itemize deductions. These distributions are made directly to charities from your IRA, and the contribution amount isn't included in your gross income or deductible on your return. Make gifts sheltered by annual gift tax exclusion before year end. In 2024, the exclusion applies to gifts up to $18,000 made to each recipient. These transfers may save your family taxes if income earning property is given to relatives in lower income tax brackets who aren't subject to the kiddie tax. These are just some of the year-end strategies that may help reduce your taxes. And you can reach out to Peach and Schwartz and Weingard CPAs if you want a tailored or specific plan that works best for you. You can also chat with us at Northbound Wealth Management if you're interested in chatting a little bit more on investment-related tax front. All right. Stay tuned for the next segment. Financial planning is the process of developing a strategy to achieve your financial goals. It encompasses a wide range of financial products and services, but it all starts with the same objective: to help you reach your goals. Too many adults have only a general idea of where they are headed financially, a sketchy picture at best. Without a plan, you're just guessing where your money is going. However, with the help of a qualified financial planner, you can understand your spending choices, boost your savings, and cut needless expenses. At Northbound Wealth Management, we work to help you reach your financial goals by recommending strategies and solutions that fit your life. You might be asking, why do you need a financial plan? Well, people think about starting financial planning for lots of different reasons. Some people have life events that trigger the need for a financial plan, such as getting married or buying a house. However, the majority of people discover they need financial advice when they feel their current level of savings doesn't match what they want to do with their life. A financial plan can help you protect what you have, save more, and ensure that your savings do the most good for you. It's the best way to be sure that your money goes where you want it to go, whether that's your retirement savings, paying off debt, buying a house, a car, paying for education, things like that. So, what does financial planning entail? Well, a smart financial plan should address 4 major areas of your life: saving and spending, borrowing and investing, charitable giving, and protecting your family. It's not realistic to expect that you'll meet all your goals in any one financial product. Smart investors choose a combination of such investment vehicles as 401k plans, IRAs, HSAs, exchange-traded funds, and mutual funds to achieve the returns and diversification they need for their long-term goals. The following are foundational elements of financial planning. The first being retirement planning. The second, estate planning, risk management strategy, and investment strategy, tax management, and charitable giving. Retirement planning. Accumulating the retirement income that you need should be a key part of any financial strategy. For a retirement strategy to be comprehensive, it should consider how and when you will use your savings and investment portfolio to provide for your future income needs. Often, this involves deciding when to start receiving income from sources such as pensions or annuities, what is the appropriate level of income from these sources, and whether additional current income should be provided by drawdown strategies from the retirement portfolio. In estate planning, a well-thought-out estate plan will consider all aspects of a person's life, including how the wealth is earned, how it will be passed on, how it will be used, and protection against unnecessary income and estate taxes upon your death. It should be created in the context of the overall strategy for you and your family. Risk management strategy. The strength of a financial strategy is directly related to the risks that may be present within that strategy. It is a framework that outlines how you manage risk across each of your insurance policies, investment decisions, and estate planning. This plan will help you organize insurance protection by reviewing your existing policies and coverage. It will also assist you and your family in evaluating the need for additional coverage by pinpointing potential risk gaps in your existing insurance policies. Investment strategy. An investment strategy is important because it determines the right combination of assets to help you meet your financial goals. It should be a key component in any financial plan due to its critical role in building and preserving wealth over time. When it comes to investing, a customized plan based on personal objectives, a risk tolerance profile, and future trends could make all the difference. In tax management, to minimize the immediate and future tax payments, sound tax planning should be an essential part of any financial strategy. A sound tax management plan will take into account immediate tax considerations and the likely impact of future tax laws upon specific investments. Charitable giving. Giving as part of financial planning works in a personal and professional way. There are sound financial reasons for giving, such as tax deductions and public image, but we believe that there are personal rewards for generosity as well. A sense of investment in your community, as well as a sense of fulfillment and breaking the power of money in your life, are just a few ways that charitable giving pays off personally. So if you were interested in having a financial plan or don't know where to start, you can reach out to Northbound Wealth Management and we'd be happy to have an initial conversation with you about that. Give us a call at 317-399-1107, or you can check out our website at www.northboundwealth.com. Safeguarding your identity, essential tips for financial security. As financial professionals, we understand that protecting your wealth goes beyond sound personal finance decisions. In today's digital age, identity theft is an ongoing threat to your financial security, with nearly 33% of Americans experiencing some form of identity theft. It is crucial to understand the risks and to consider taking protective or proactive measures. Common types of identity theft are credit card fraud, which is unauthorized use of your credit card information, government documents or benefits fraud, misuse of your personal information to obtain government benefits or documents, loan or lease fraud, using your identity to apply for loans or leases. Financial implications of identity theft. The financial hardships caused by identity theft can last for months or even years after your personal information is exposed. Depending on the type of data identity thieves obtain, the recovery process can involve several hurdles. Victims often need to dispute fraudulent activities in their credit files and work to restore their good credit. This may include cleaning up and making changes to compromised bank accounts. Common sense protections. While technology-enabled safeguards like antivirus protection software, password managers, and two-factor authentication can help, there are also other actions that you can consider. 1. Don't let your mail sit uncollected for too long. Don't give thieves time to steal sensitive documents from your mailbox. And 2, review credit card and bank statements. By making it a habit to check your statements, you may be able to spot suspicious activity. 3, freezing your credit. Prevent unauthorized access to your credit report by freezing your credit. 4, create different passwords for your accounts. Consider using long, complex, and unique passwords for each account. 5, consider shredding documents with personal information. A household shredder can be used on documents with personally identifiable information. 6, review your credit reports. Monitor your credit by requesting reports from major credit agencies at different times throughout the year. 7, opt out of pre-screened credit card offers and unsolicited credit card offers to help manage the risk of fraud. 8, clean out your wallet. Avoid carrying sensitive information like your social security card, checks, and password cheat sheets. 9, bypass the PIN at the gas pump. Use your zip code instead of your PIN if possible. safe disposal of digital devices. So, properly disposing of old digital devices is a key but often overlooked part of identity theft. Simply deleting files may not be enough on some digital devices, as thieves may be able to recover the data, especially if you're saving everything to the cloud. Identity theft protection services. So, identity theft protection services offer a range of features designed to detect, alert, and assist in recovery from identity theft. These services typically monitor credit reports, dark web activity, and public records for signs of fraudulent use of personal information. What to do if your identity has been stolen? If you suspect your identity has been stolen, look out for warning signs such as bills for items you did not buy, debt collection calls for accounts you did not open, and denials of loan applications. The next step to consider is placing fraud alerts or security freezes on your credit reports. Protecting your identity is an integral part of maintaining your overall financial health. By staying vigilant, you may be able to reduce your risk of becoming a victim of identity theft. If you have any concerns about identity theft or would like to discuss how it fits into your broader financial strategy, don't hesitate to contact us. We're here to help provide you with information that can help improve your personal finances. The sources of this come from identitytheft.org, 2024, U.S. News and World Report, and Discover. Thanks for tuning in. Thanks for listening to the Northbound Wealth Podcast. Like, subscribe, follow us on social media handles, and have a great week and weekend. We'll talk to you soon. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.